Hi, my name is Vanessa Jenkins, and this is my mini case study for Parsi Anias in financial reporting and analysis. So, some background information on Parsi Anias. Parsi manages a team of professional buyers responsible for procuring all of the company's raw materials. These materials include metals, chemicals, plastics from around the globe that cost millions of dollars. These materials are then used to manufacture the company's products, including a new line of refrigerators that they launched last year. Parsi's team is primarily measured on the cost of materials that they purchase. So they're expected to continuously source out products to bring down their costs when purchasing these materials. So Parsi is also responsible for producing financial forecasts. Because he has a knowledge of material costs, he's expected to create these estimates on how much the company will spend over time or within a period on these materials each month or each quarter. The forecast is then used by internal and external users to make decisions. So the engineering team had estimated that 11.22 pounds of polyurethane foam will be used in the manufacturing of this new line of refrigerators. But when they did a physical inventory um, at the end of the quarter, they determined that $350,000 worth of polyurethane was missing. So it came out that more than 11.22 pounds of the polyurethane was used to manufacture these refrigerators. So, since there's an error on their account, they have to fix it. So, it's not balanced. So, let's look at cost of goods sold versus inventory. So, inventory is the value of products to be sold or items to be converted into sellable products. It is an asset to a company until they are used. It is recorded on the balance sheet as an asset as the amount paid for the purchase of the inventory. Cost of goods sold is the cost to produce the goods or services to the customer. This is reported at the end of an accounting cycle to reflect the amount of inventory the business has sold. So, now we have an example of a journal entry and also our T accounts. So in the journal entry, we debit inventory for $20,000 and then we credit cash. The raw material was purchased with cash. So then below at the end of the month, we debit cost of goods sold $10,000 and we credit inventory $10,000. And this is the use of the raw material. So in our T accounts, we credit cash $20,000, and you can see the $20,000 credit. Inventory, there's a debit and a credit, so that leaves a debit of $10,000. Cost of goods sold, we see that there's a debit of $10,000. So next, let's look at how we make our adjusting entry to make the account balance for Parsi. So again, because of Parsi's team's under calculation of how many pounds of polyurethane would be needed for the refrigerators, this caused an error in when they were counting their inventory. So the adjustment entry that's needed to make their account balance, we would need to debit cost of goods sold for $350,000 and then credit inventory for $350,000. And this is the end of quarter adjustment for the loss. This will then show that this will then balance out their accounts. So in the T accounts, we would then credit $350,000, and this reflects the loss in inventory. And then cost of goods sold, we would debit $350,000. So my suggestions to Parsi: review inventory on a weekly basis, and that way he can avoid any accounting issues in the future. I mean, this is just so he always knows how much inventory he has, and there's less room for error. I would also involve the engineers more. They're subject matter experts. Yes, they made the mistake, but with them working together, that will help eliminate some of the mistakes that are made, and they can both create a more accurate cost analysis for the raw material needed to manufacture the products. Um, since they already source out different products and are trying to lower their costs, why not find a product that's cheaper than polyurethanes to insulate refrigerators to help bring down the cost? And thank you.